If you don't like paying taxes, this video is for you. Here is the Mega Backdoor Roth 401k. Welcome. My name is Loic Lemenner, founder of Opus Wealth Management. Let's begin with why this might be a big deal. Well, I did some quick math, and if you can put an extra $25,000 a year into a Roth for 20 years and earn a little over a 5% return, you'd have about $1 million in a tax-free account. Over 30 years, you'd have $2 million. And that's per spouse. So if a married couple is lucky enough to do this for both spouses, you could potentially save $4 million of tax-free money. Now that is nothing to sneeze at. Here's how it works. There are 3 types of contributions you can make to your 401k. The first is your normal 401k contribution, which can be pre-tax or after-tax. Deciding which one to do is outside the scope of this video, but just think to yourself, normal 401k contribution for 2024, under 50 years old, that limit is $23,000. The second bucket is your employer match. If your employer is generous enough to give you a match, you automatically get that for making your contributions. Company matches can be all over the place. So in my example, I just assumed $20,000. So you're done, right? Well, no. The IRS limit for total contributions into a 401k in 2024 is $69,000. Again, if you're under 50 years old. If you're over 50, remember that you get a $7,500 catch-up provision. Whoa, so how do I fill up the rest of this allowable amount? Well, there's a third way to contribute to your 401k that's often called an after-tax contribution. That's how you fill up the rest of this allowable amount. The amazing part of this strategy is you can take after-tax dollars and immediately send them to your Roth account. You end up with substantial dollars that would have ended up somewhere in a taxable account, but instead grow tax-free inside a Roth. And you can do this every single year. So how do you make this happen? Taking the after-tax dollars from the last slide, converting them to a Roth so that they can grow tax-free for you from then on. Well, there are 3 ways to do that. One is called an in-plan conversion. This is where your plan allows you to take money from the after-tax 401k account and move it to a Roth 401k account. And that is all done within your 401k plan. The second way you could do this is if your plan allows for in-service rollovers. What that means is while you're still working for your employer, your plan allows you to do rollovers to an IRA. So you simply take the after-tax dollars and roll it directly into a Roth IRA in your name. And the third way to do that is if your plan allows neither of these options, but you're nearing retirement or think you might change employers, you can build up these after-tax dollars. And when you change or leave your employer, you can then roll it into a Roth IRA. Since you won't be able to do that immediately, there will likely be some growth in the account that you can't roll over to a Roth. But all the after-tax dollars you socked away and contributed to the after-tax account can be rolled over into a Roth IRA. So how do you know if you can do this? Well, there are 3 main questions to ask. Do not ask your 401k people, can I do a mega backdoor Roth conversion? That's not written anywhere in your plan and they may have no idea what you're talking about. The 3 questions to ask are, can I make a contribution up to the 415C1A limit? That's the IRS maximum salary deferral limit from all sources. That will let you know if you can do the after-tax contribution part. The second question to ask is, can you do a Roth conversion within the 401k? That's the feature that will allow you to move money from the after-tax 401k account to the Roth 401k account. And then lastly, can you make an in-service IRA rollover? That's where you continue to be an employee of your employer, but they allow you to roll money from the 401k to an IRA while you're still in service of that employer. I've seen a lot of plans have that feature. Some of them have an age limit to them. So they'll say you can do an in-service rollover after you attain the age of 50. Better yet, you can get the summary plan description and ask your advisor to see if these provisions exist. That way, you're not beholden to whoever answers the phone at a big institution that may not know your plan very well. We did some research to see which companies could take advantage of this, and we came up with a few names amongst the big firms. Now, the odds that you work for one of these firms may be low, but you probably know somebody at one of these companies, and what's a better gift than letting them know about this? And remember, if your employer doesn't let you do this, you can ask them to amend their 401k plan. It doesn't cost them anything, and it could be a huge benefit to you. Saving the worst for last. What's the downside of this? Well, you have to watch out for the total salary deferral limit, which includes your employer match. So you got to make sure to do your math at the beginning of the year, because if you throw too many after-tax dollars into your 401k, you could actually crowd out or miss out on some of your company match. A second issue is that if you work for a small company that allows this, but you're a highly compensated employee, which the IRS defines as $150,000 in 2024, you likely won't be able to do this, or you'll make your plan top heavy. However, if you're a business owner, there are ways to create or refine your existing retirement plan to do this. So ask your advisors about it. That's all we have for this video. I hope it was helpful. Please like or subscribe if you want to encourage us to do more of these, and I appreciate your support.